These platform companies are basically massive new business incubation engines. You have a huge advantage to then take one or both sides of the existing ecosystem and then use that latent demand or latent supply and channel that to supercharge a new business. Then you have to ask yourself, okay, well, what do the next 10 years entail? Do we think that this cycle is going to repeat itself? My answer is absolutely yes.
So there's basically two camps of investors, generally. There's value investors and there's growth investors. Value investors are saying, okay, we are going to look for businesses that the true value is not priced in correctly to the market, right? So what you're saying is, you have a hypothesis about a specific stock or maybe a specific vertical that there's going to be either there's a gross misalignment in their assets. Typical examples are like this business actually owns a lot of real estate and they're a retail business, or there's some kind of restaurant business and they own the real estate and the real estate isn't properly priced into the overall stock price.
They're trading at a discount basically to their assets.
And this was true of like the oldest activist investor stories of the early 1900s, where they would go to these railroad companies and then these railroad companies would have these massive real estate holdings. And they would say, hey, I mean, like literally, if I look at the valuation of the railroad business and I look at how much real estate you own, those two things are the same. It's not even pricing in the operations and the profit that's coming from your actual railroad business. Hey, company, you should come in and you should sell off your real estate so that, and pay a one-time dividend or something like that to investors, because there's a huge discrepancy in what your company is actually valued at and what the market is pricing it at. Again, I'm overgeneralizing here, but you could generally say that is the value investor theory. It's either on a company level or a sector level that something is not being properly recognized in the public markets. The growth investor model is a little bit different. And what that's saying is that we believe that this company, although it already has very high, say, revenue multiples or PE multiples, right, that they are going to be able to outperform over the future, and that they're going to be able to continue to have growth that is basically not priced into the current stock price. And so naturally, growth companies would resonate with tech companies. And what we've basically seen over the past 10 years is that growth investors have done much better than value investors. Why is that? If you look at FANG, if you look at just a lot of the tech companies, they've been able to continue to outperform. Why is it that many of the world's largest companies, now tech companies, Facebook, Amazon, Microsoft, Apple, Google, Netflix has also done very well, even though it's not a platform. Why is it that these large cap tech companies have been able to continue to outperform and continue to beat earnings? Maybe they miss one earnings here or there every, say, like 20 earnings cycles or something like that. But why is it that this is able to happen? And here's what's going on. Yes, these platform companies are basically massive new business incubation engines. And these platform companies create one dominant platform in, let's say, Google search, right? Let's say Google search creates a dominant platform to connect you to other websites. And now then Google's going to go and have multiple other teams that are then spinning up adjacent platform businesses that can then leverage one or both sides of the existing platform in Google search, or other value add services or just advantages that Google has, given that it has a dominant platform business in search. What would be some examples of this? Let's jump into that.
Well, I think one of the big ones that's been a success for them is Android. So they acquired this, at the time, small company called Android
for $50 million.
And basically that became the today dominant, or along with Apple and iOS, the dominant mobile operating system. And the goal for them was basically, we saw this as a defensive measure. So it's not that I'm Google and I'm going to go charge all these handset makers for Android and make tons of money that way. I'm going to give this away for free. And what it does is basically provide me with a avenue to put all my Google products, so things like Google search, on a phone without having to pay for access. So if you look at what Google does on the iPhone, they pay Apple a huge sum of money to be basically the default search engine or one of the default search
It's
engines.
at least $1 billion a year
Available on the iPhone. So the thinking
Actually
from
kind of a
Google's point
bargain.
of view is if I create this platform, it helps me defend search because I don't have to pay to get access to all these customers.
So here I'm just going to rattle off some names, okay? So Google Search, dominant platform business for Google. Cash cow, churning off a bunch of cash, right? Then you have Android, YouTube, okay? You have G Suite, so all of the different like Google apps and things like that. Android Automotive, Waymo, Google Home. Now, things that they've tried and have failed, home services, Google Glass. They bought some robot companies and sold those things off. You know, basically they have 100+ teams that are basically just trying to spin up other platform businesses. If you think about Facebook, okay, Facebook has had the dominant social network. Then they launched Pages, and now they have more of a content platform. Then they launched Facebook Marketplace, right? Then
Messenger,
and then that kind of did okay. And then they bought
Instagram,
and WhatsApp. And then along the way, there are multiple other initiatives that they try and start and fail. And that's kind of the model. So what's interesting is that this is the mechanism that they've used to try to be able to outperform time and time again and to have 10+ year runs where they're able to continue to say, look at the growth that we have. And that to me is very different than saying, I'm going to value Google and the business of search and maybe some of YouTube and Android. But then how do you appropriately price in the growth initiatives? And this is where platforms are in a very special place to do this, because when you have, by definition, a two-sided marketplace or a two-sided ecosystem, you have a huge advantage to then take one or both sides of the existing ecosystem and then use that latent demand or latent supply and channel that to supercharge a new business.
Yep.
And it means that you can either spin out new businesses organically with a much higher rate of success, or you can buy business at multiples that almost no one else can afford. But for you, it's economical because then you can layer in all these other complementary or compounding network effects on top of it.
That's what happened with both Instagram and YouTube, where when Google bought YouTube at the time, people thought, oh, this is crazy. Great acquisition, done very well, worth well above what they paid for it.
And they had Google Video
even
at the
if you
time.
adjust for inflation. Right. And same with Instagram. It was, $1 billion acquisition. Back then, that was a huge acquisition. And it has done very well for them and has really become one of the huge growth areas, both in terms of users and revenue for Facebook.
And I think that is basically the mechanism as to why growth has been able to outperform value for the past 10 years. And then you have to ask yourself, okay, well, what do the next 10 years entail? Do we think that this cycle is going to repeat itself? And my answer is absolutely yes. There's nothing stopping these companies from continuing to try to spin out additional platform businesses. If anything, they have now hundreds of teams where they might have had 10 teams before. Amazon has literally basically trademarked its process to do this in the 6-page memo, right? Where Jeff Bezos, you're basically delivering a 6-page. I don't know if Jeff still reads every one of these, but he used to read every single 6-page memo. And it was a 6-page memo. It has a certain structure to it. And it basically is saying that you're going to write the press release for the launch of this new platform business. And that press release is going to obviously give an overview of the value prop and all these kinds of things. And it's going to have a bunch of FAQs, frequently asked questions. And then that 6-page memo is basically kind of the platform hypothesis that this team is then going to go out there and try and deliver upon and validate. And Amazon has done this just as well as any of the large tech monopolies. And so then you have to ask yourself, well, what's stopping from Amazon continuing to do this? I guess, do they get too big and they can't focus and, they get sloppy at doing this? I don't think we've seen anything that is indicating their inability to do this or that their size is preventing them from doing this to a lesser degree of effectiveness. And
I mean, we've seen them do it very successfully recently with Amazon Business.
Mm-hmm.
So I think that you're starting to see
Echo and a number of other things that Amazon in the freight and logistics space and all of these things. I mean, it's just so. Then you have to ask yourself, okay, are the large tech monopolies going to continue to outperform? Yes. And then you have to say, okay, well, for platforms in general over the next 5 to 10 years, could more dominant platforms actually start to emulate this new platform business incubation engine? And I also think they're going to be able to do it. Look at Uber. We were just talking about Uber and Uber Eats and Uber Freight.
Okay. Yeah.
And, then they've got the helicopters and all these and autonomy and all these other things. But you're now starting to see recent IPO businesses expand into adjacent platforms. And now what you're really seeing is this league of platform conglomerate. And I think that's really what I would define this as, is the moment you have a dominant platform business in one area, and now you're able to spin out complementary platforms in similar or adjacent or complementary areas, you get platform conglomerate status. And so Uber is definitely in platform conglomerate status. Lyft is not. That's what we were just talking about a couple episodes ago.
Yep.
What are some other companies that you think are getting into platform conglomerate status?
I think Booking, which we were just talking about earlier, would definitely qualify. They've got a number of different platforms within the different types of accommodations and reservations, as well as OpenTable, which we were talking about earlier.
Mm-hmm. I would throw Slack in there.
Yep.
Communication platform. They launched a VC fund a few years ago to spur for other startups to build software on top of Slack and other integrations. And so now they have a dev platform angle going on top of that.
Yeah.
I'd say Bloomberg is a platform conglomerate that not many people are familiar with, right? It started out with a lot of the messaging and kind of social networking on there. But now they also have an app marketplace. They have a data marketplace that you can now put software or additional data into the marketplace and people can buy it. We should actually make a list of all the different platform conglomerates.
Right. Big companies with multiple platform types that they built successfully on top of each other.
Exactly. And I think there's a number in China that we're seeing do this.
Certainly.
And so I think that's the mechanism for where can growth businesses who already are, say, hitting a point of maturity in the core business outperform. It's in their ability to become new platform business incubation engines and to really make the evolution into platform conglomerate status.
Yep.
Which Dara was very familiar with, by the way, at Expedia, transitioning the business into that. They also have multiple platform initiatives going on in Expedia. And so I think that doesn't mean that Lyft won't be able to outperform over the next, say, 5 years, just on its core business. I think it's really at the point where you say Lyft in 5 years, once the ride sharing business is more mature, is a Lyft, are the number 2 platform players in a given vertical, are they able to figure out how they could become platform conglomerate? Because then that's kind of where your growth could slow.
Right.
And you could kind of plateau. You need to be able to fill out that chart and have multiple kind of rising stars.
Yep.
And
you need those growth initiatives,
yes,
those new platform types that are coming up as the current one matures.
Hi, this is Alex Mozed. Thanks for joining us on Winner Take All. If you enjoyed the content today, which I bet you did, please comment, subscribe, and definitely message me on Twitter when we're doing live streams. Also, please note, all opinions expressed about stocks or public companies on the show are exactly that, opinions. This is not investment advice. Don't act on it. WisdomTree licensed Applico's Platform Insights data product to aid in the creation of the Plat ETF. Thanks for joining us.